Hey everybody, we are live. It is Rob Keens, your host at 𝘨𝑀𝑒𝑑𝑎LS.com. Cowboy Medals live stream Tuesday afternoon, broadcasting at 1 p.m. Central Time. Thank you everybody for joining the broadcast. We're all glad that you are here. We're going to get started in just a moment while YouTube gets everybody loaded into the stream, and we did a sound check and sound is up. We do have a poll up. Europe appears set to join the superbank empire forming around the world. Can it be stopped? I'll be interested to see your votes on that. I think it could be somewhat different than mine, as is always the case. Thank you everybody for joining. Mickey is here. Neil's here as well. Thank you so much for joining the program. Today, we're going to be talking about European Union and building a mega bank. And this has come across my inbox and across social media a lot lately. And a good friend of mine has been following this and urging me to talk about it. So I'm going to talk about it today. And the formation of a European super bank could be very dangerous to monetary freedom for European citizens, but also the development of these various super banks around the world is a danger to freedom everywhere, because the more of these that pop up, the less places there are to go to be free, the less places there will be to go to transact with free people. And essentially, we're building what I think amounts to a financial prison planet around the world. Not something that I love, but something that is occurring nonetheless. And I think that this also feeds into central bank digital currencies, which I'll talk about for just a moment. I really want to focus on the banking piece of it. And then I'll talk about at the end how I think the CBDCs may be involved in that as well. So let's go ahead and get to the share screen, guys. Looks like everything's working. Yay, our live stream is working. We're going to start off here with an article at Santander. Santander is an international bank, a Hispanic bank, but has branches everywhere. And Oliver Wyman wrote an article, and they're talking about the different realities between profitability and capital in the U.S. and EU banks. So in other words, a lot of what you'll be seeing today is talking about how the EU is not set up like the U.S. and how it needs to be set up like the U.S., which is not necessarily a good thing, but I want you to understand their thinking and then how that's going to play into central bank digital currencies. So it says here, Oliver Wyman released a report commissioned by the European Banking Federation with the aim to provide a quantitative and independent assessment of the regulatory and supervisory costs for the European Union banks compared to U.S. banks. Now, people that write these reports are chosen ahead of time. It's not like they just said, go find the smartest guy. A lot of times these people are chosen because they already have the view that whoever's hiring them to do this wants to espouse. So just Oliver Wyman might be the smartest person in the world, but I suspect his views were known before he ever did this report. According to the report, a review of current capital requirements and supervisory processes could, in a hypothetical scenario, provide capacity for $4 to $4.5 trillion additional bank lending for EU banks to support the financing of green and digital transitions. Aha! Now you know why they want a super bank. They want the green and digital transitions. The green transition is control of the economy through carbon-based credits and those types of policies. And digital transitions, that's digital money, ladies and gentlemen. That's central bank digital currency. It's needed to support the green and digital transitions. They have to have the European mega bank, or they can't do central bank digital currencies, and they can't control you through the green policy or the ESGs. See how those two are related. Main takeaways of the report: lower profitability of European banks versus US banks due to structural factors. The return on equity of the EU banking sector today, 6.7% on average in 2021. It's not earning its cost of capital when U.S. competitors have returned to pre-crisis profitability levels of 11%. Now, first of all, I like to point out that the banks are making money hand over fist, 11% in the U.S. and around the world, I guess, in some cases, where the rest of us are losing money because inflation's more than our wages. And yet we're worried about the banking system earning an extra 5% from 6.7 to 11. Hey, how about we raise the salaries of everybody 6.5% or 11% and allow the consumers to go out and compete and spend money? And maybe that'll help the banking sector rather than giving the banking sector all the profits by having a monopoly of money. Yet, that's not good for the people, okay? It's not good at all. But it's good for the bankers, and that's why they want it. According to the report, this has been driven, among other reasons, by an economic environment of comparatively poor growth in the Eurozone, different fiscal and monetary conditions, high fragmentation, blah, blah, blah. We'll talk about fragmentation. It basically means the laws don't allow for the banking system to go over and take all of Europe over. So in Europe, you have more sovereign banks or state banks that aren't crossing borders, and cross-border payments are low. And that actually has led to more freedom of choice in the banking sector in Europe, because you don't have the mega banks taking everything over, but the mega banks don't like it. So now they got to talk about liquidity and cross-border payments, and we're not like the US, and we need to be by the US. Why? Because it's ushering in of these controls, these reforms of the system. That's why they need to do it. It doesn't surprise me at all. It's happening now. In fact, I would expect it would have happened 5 to 10 years ago. You could have had this conversation during Brexit at the same time, but perhaps that was too soon. Going on in the article, lower profitability of European banks are also due to differences in how rules effectively work and how they're implemented. The report concludes that EU banks face an incremental regulatory induced cost compared to US peers that could explain about a percentage point of the gap. They have more complex and they face twice as high a contribution to deposit resolution funds. In other words, they have more liquidity. So of course, it costs more. They're required to keep more liquidity. What they're talking about here is reducing the liquidity requirements of the banks, which is not good. Just because they passed recent stress tests, it's not good. Well, here at Bloomberg Law, we get a confirmation of this, them wanting to build a super bank. And that's actually used here at Bloomberg Law. This is actually in Bloomberg's regular magazine as well. I just happen to use this version of it. So it was on Bloomberg's front page. Europe's US-style super bank dream is further out of reach. Slumping cross-border loans show fragmentation getting worse. Diverging borrowing costs also expose integration failure. The solution for Europe's struggling banks, many of their CEOs agree, yeah, because they're only making 7%, so they're struggling. They're not making 11. Give me a break. At least they're making money. What about the rest of us? The CEOs agree is that consolidation that creates cross-continent super banks, an American-style fix that by several measures is sleeping further. Wait, this is an American-style. What part of the U.S. banking system do you think is better than Europe when we just had 3 of the largest bank failures in the history of this union of the United States of America, and yet our banking system's in better shape? What pot are you smoking? You're mainlining crack cocaine. This is an asinine article. Europe is already so far in better shape because they don't have the integration of commercial commercial loans, separation of commercial and industry, which we'll get to in a moment, which is what they're proposing. This is insanity. Europe banking system may have issues, and it does, especially with a lot of negative interest rate debt floating around there. But man, it ain't as bad as the US, but they want to make it like the US. Why? It has nothing to do with solvency, because if it did, the Americans wouldn't have banking problems. And 2008 that nearly took down the entire world's economy. And in the last few months where we had some of the biggest bank failures in the history. Yeah, but our banking system's okay. Let's just make Europe just like the US, because that's going to solve the problem. Wink, wink, nudge, nudge, right? That's the solution. This is asinine and stupid, but what it's for control. It's not about anything else. It's about control. That much is obvious. Let's go back to the articles that we're talking about here. As we go further, I have a nice little paper written by 𝘎𝑺. And who is 𝘎𝑺? It's one of these think tank research type organizations that proposes all these changes that are helpful. Who commissions them? The government and the well-to-do in nation states. And they're there for the benefit of the well-to-do, the government in these nation states. That's why they do the reports. And they do the reports so they can form their technocracy, and they can tell you this is best for you. Take your medicine. Okay, you can't have dessert till you eat your meat, as the Pink Floyd song goes. Another brick in the wall. You're just a brick in the wall to these people. I'm telling you right now, you're a brick in the wall. They don't give a rat's ass about you. Listen to this report. While we have come a long way since the establishment of the single supervisory mechanism, the banking union is far from complete. They're already talking about merging the banking union, and we'll get into 𝘍𝑚 here in a minute, and how that was an absolute travesty when portions of that were repealed by Graham Bleach Lively. An efficient banking union would break the sovereign bank vicious circle, foster a more effective allocation of resources across the Eurozone, and help to achieve better diversification of risks as contributing to private risk sharing within the union. One of the things they're going to be talking about in this report is private risk sharing. In other words, they're going to sell you all their effing crap so that you take it in the shorts so that they don't have to. That's called risk sharing. They're going to push it on you because the banking system is insolvent already, and their solution is to steal your money. That's what they want. And the report goes on, despite the challenges faced in recent years, many European countries' banking systems remain oversized and still have surplus capacity. See, they're doing just fine. So why do you need the super bank? They got more banking than they need, and their answer is to consolidate control and take up all that slack into a mega bank. Why? Because it guarantees their profit levels. They got to get up from 6.7% a year. It's not enough. Forget the fact that the people in the European Union are starving and don't have jobs. Their women are being raped by immigrants. Let's not talk about those things. Let's talk about how the bankers don't get more than 6.7%, and they're jealous of the U.S. counterparts. So they want the 11% plus, and so they're going to go create a super bank and shove it down your throat. Bank profitability continues to be hampered in Europe by overcapacity and competitive environment. Oh, competition's bad. We need to get rid of that. They don't want competition. This isn't capitalism, guys. This is Marxism. This is socialism. The limited strength of private risk-sharing channels in the euro area reflects both the underdevelopment of capital markets and a highly segmented banking system at the national level. There is little progress in cross-border lending, especially in the retail markets, or in other words, lending to households and firms. In other words, let me finance all the freaking crap in the economy we need to and stick it into your 401k and your passive funds so that you can take it in the shorts when it fails. That's the translation there, ladies and gentlemen. The banking union is failing to provide the expected degree of financial integration. In other words, control. Integration means we control. We're going to integrate what was separate before so we can control. That's what integration stands for. Substitute the word control for integration throughout this report and you get the real meaning. They're hiding it with creative wordplay. Integration means control. You integrate to grab control of something. I know I've done systems integration projects for many years in corporate America, and so that you can have better what? Control. A fragmented banking landscape in the European Union. Indicators are continuing to signal banking fragmentation in Europe. The share of cross-border loans to households and cross-border deposits from households remains negligible, around 1%. So they're not able to loan from France to Germany, and they want to control it all. So they're getting rid of the national sovereignty. They're getting rid of the physical and the financial borders, and they're going to merge the banking union into the credit union, which I'll show you in a moment, the capital markets, and it's going to be the repeal of Glass-Steagall, European style. And we know what happened in the US when that happened. Here in chart 2, we have share of cross-border deposits in the euro area for NFCs, non-financial companies, and households. So you can see non-financial corporations are serving the needs of their customers. Those are any corporation that's not a bank, but facilitates money. It could be PayPal or something along those lines. Those are taking up the slack for the things that the banking system doesn't have, because the banking systems are god awful all around the world. One of the reasons the rest of the world's developing their own wire systems, one, to get out of underneath the U.S. military and sanctions, but also because our systems suck. They're outdated. So a lot of these NFCs provide services the banks can't, but the banks don't like it. They want to cap what this chart is showing you. They want to take all this money away from those third-party private institutions, which help you facilitate money transfer, and stick it all into their system. This is just akin to the U.S. wanting to get rid of Venmo and PayPal and stick everybody on FedNow system so that they can control you. They don't want the third parties. They're lamenting it in the report. Sovereign bank nexus on the rise. Listen to this. Moreover, despite the quantitative easing policy of the ECB, the doom loop between banks and their sovereigns is far from being resolved. In other words, they're admitting they printed all this money and it has no chance in hell of stopping the central banks from going collapse. That's what they admitted in this report. They printed all the money and it won't stop the collapse. And now they got to take all your money and integrate, control your capital flow, so that your labor can be used to pay for their policies and they never have any repercussions. That's what that says. That's plain English for what they wrote there. They're telling you who they are. They're statists. And they don't care about you. They want control and they want return. And they're going to get rid of any solution that you might have developed in the private market because they don't want you to have it, because they don't care about you, ladies and gentlemen. According to ECB, between January 2020 and September 2020, Eurobank's exposures to domestic sovereign debt securities have risen by almost 19% in nominal amount. The share of total assets in domestic sovereign securities varies across countries. At the end of September, it was equal to 11.9%, blah, 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 blah. So people are investing in their own sovereign. They're not going cross-border. Sovereign exposures as a percentage of total assets per country has gone up in Europe. In other words, people are taking on, the banking system is taking on the sovereign debt, and they know it's going to bankrupt the banks, which is why they want cross-border payments, so they can take all the people. Let's say you have a really bad banking system in France. Now you can transpose it onto the German people, the Greek people, the UK, whoever's in this European Union. I know UK's Brexit, but they're going to participate. They're going to get it second order effects. They want this, everybody. They want anybody in this system to take on all their bad policies, because their policies are so bad. They're starting to bankrupt the system that they're going to try to mix it all up into one big mess and control it. And they think that they can't. And this is insanity. It's insane what they're doing, but this is their plan. Sovereign bank loop is reaching significant levels. The asset purchase programs of the ECB mainly have contributed to this dynamic since 2015. Indeed, the share of government debt held by the National Central Bank has almost tripled in Italy and Spain between 2015 and 2020. As of September 2020, nearly 21.6% and 23.3% of the government debt was held by Italian and Spanish central banks. So you know who their biggest ones are in trouble? Italy and Spain. Boy, isn't that the last time this happened? Wasn't it Greece, Italy, and Spain that were handling this? Holders of government debt. You can see it going up. The central bank is going up. The central banks are going to take it in the shorts when this debt collapses. That's why they need to get rid of the risk. This chart right here tells you the central banks are freaking out because they don't want the risk and they need to spread it through cross-border lending to all the people, regardless of nation state. This is how you build a mega bank. You increase the population of people and you combine industrial and commercial banking into one. That's how you do it. You take customer deposits, you throw them into risky assets. When it fails, you have bail-in laws. That's the system that they want to implement. It's plain, it's black and white. The fragmented banking sector across domestic lines, you're using words like fragmented like it's bad. No, it means independent, sovereign, and solvent. They don't want that. They don't want independent, sovereign, and solvent. It's fragmented. It's we can't allow the individual banks and countries to control their money. No, we've already got the euro. We need all the banking. We need it all. We need it all. Ah! All right. The European banking sector has too many banks with heavy cost structures. Yeah, because you got too many damn banks and nobody needs them. Why don't they need them? Because they don't have any money to spend. So let the banks fail. Let them fail. That's the way it's supposed to happen. It's called contraction in the economy when you don't have the production. And the banking system is basically saying we need to be financed and we need to be, combine this all together so we don't have to go to business. We don't want consequences. Cost to income ratio of U.S. banks going up. Bank branches per 100K population. There's a lot. It's called competition. It's not bad. They want to bring it down. It's something like 60% more competition in Europe than the U.S. And they're saying in here that's bad and they want to bring it down. It's literally what they say in the report. And they're not making as much money. Look at the chart. Oh, we're not making as much money on our return on equity. The U.S. banks went up and they're just jealous. Here's the U.S. banks in orange. Since COVID, the U.S. banks have done better on return on equity. And the Europe is jealous. Well, here comes Luis Guindos, Vice President of the ECB at the annual joint conference of the European Commission, the European Central Bank on European financial integration. What do they want to do? Merge the banking system, the commercial banking, your deposits and loans with the capital markets, the bond and stock markets. Gee, where have we talked about that before? What about Glass-Steagall? Let's read the history of this in the U.S. according to the Federal Reserve Bank of St. Louis. The separation between commercial and investment banking has been one of the primary features of the U.S. financial system since the 1930s. Congress is responsible for this separation, having decided that investment banking activities of the nation's large commercial banks contributed to the widespread bank failures of the Depression. You think? To prevent further failures, it passed legislation in 1933 that created a wall between commercial and investment banking activities and authorized a federal deposit insurance system. Since the Depression, a number of academic studies have suggested that such investment banking did not significantly contribute to massive bank failures. Wrong. So you had this banking marriage, blah, 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 a marriage on the rocks. The divorce decree was Glass-Steagall. Under the Banking Act of 1933, or the Glass-Steagall Act, as commonly referred to, banks were forbidden from purchasing securities for their own accounts, issuing, underwriting, selling, or distributing at wholesale or retail or through syndicate participation, stocks, bond, debentures. What do they want to match? Capital markets, stocks, and bonds with what? Commercial deposits. What is Glass-Steagall? Separating those to prevent what? The Great Depression. And yet Europe wants to stick them together because they're already going to hit a Great Depression. And instead of allowing those banks to fail and allowing capitalism to occur, they want to make it worse and merge them together. We saw what happened in the U.S. when that happened. And the Great Depression led to a world war. This is not good. This is not what we want. It also forbidden from affiliating with company principally engaged in the activities listed above. So they couldn't buy all the private ones or have close relationship with the private. It allowed separation between commercial banking and private money services and private financial services, which actually offers, in the U.S., it offers more choice for consumers as to what they use. And Glass-Steagall Act also forbid having interlocking relationships or close employee relationships with a firm principally engaged in security underwriting through boards of directors and sharing resources. Over time, some of Glass-Steagall was repealed, not all of it. In the United States, you can be a commercial bank and do investment banking. Not all of Glass-Steagall was repealed, but a lot of it was. And we saw since that happened, we saw 2008 Lehman, what was caused by that? Their deposits wouldn't support their investments. What happened to Signature Bank and Silvergate and Credit Suisse? Their deposits or their assets wouldn't cover the losses in their what? The industrial side, the investment side, the bonds primarily. So we already know what happens when you allow a bank or any institution to take customer deposits to try to cover the risk in the investment side, the stocks and the bond markets. It doesn't work. Then you have to have bank failures and stuff like that. That's essentially what's going on. But he wants harmonized and effective supervision. He thinks supervision and the creation of an FDIC in Europe would solve the problem. But we had supervision and FDIC in the US, and we still have major bank failures this year. And most people think it's not over yet. We're going to have more. So how does this help deal with the issues in Europe? It doesn't. But see, he's a vice president of ECB. He wants to increase their power, and he knows what's coming. And he knows the only way to prevent this collapse is to merge the commercial and investment sides, and then create a super mega bank, and then have all those bail-in laws so that you can control the whole kit and caboodle. Why? Because that's what they want. That's what they want. That's what's going to happen. Conclusion. The Euro area financial system recently passed a real-life stress test. Yeah, but they don't mean anything because, first of all, they don't really adhere to the requirements of the stress test. And two, they don't have enough liquidity anyway. Not for something like Lehman. The stress test wouldn't prevent that. Okay, continuing. At the same time, the events of this spring underline the importance of making decisive progress on the European Banking Union Capital Market Union projects. The financial market turbulence and contagion for the United States and Switzerland would have been far more muted had we been closer to our goals. Completing the oh, that's right, because the United States has a system you want, and you're talking about that contagion coming to you, and now what's your solution? Doing the exact same thing that had contagion coming towards you. See, there's so much hypocrisy in this report. They're talking about the issues where they're coming from, but then enacting the same system of where those issues came from, like that's going to be the solution. And they know it's not the solution. It's about control, and it's about not admitting they made mistakes with the current regime. They don't want to. What banker ever wants to do that? None. They're going to drive us off the cliff before they ever admit fault. That's just the way they've been throughout history. It's just the way it is. Okay, a lot of them are narcissists or sociopaths, or a lot of them just can't admit they're wrong. They can't. So they will double down and go into an insane policy that they know is not going to work, rather than admitting defeat and changing. They won't. Completing the banking and capital market union projects will increase cross-border bank lending, i.e. spreading risk from high-risk areas to people that don't, to people of other sovereign nations that have nothing to do with it. And enhance the dynamicism of public and private equity markets. No, what it allows you to do is a bunch of people to get rich off having close relationships with banks. And who are those people going to be? They're buddies. Both are key to enhancing integration and stability in the Euro area. Blah, 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 garbage, blah, garbage, blah. I'm sorry. I'm not buying into it. I think it's all garbage. I'm going to do another quick sound check. Sound is doing good, everybody. Welcome, SAS Finance EC660. John Bethea is in the house. Thank you for joining, John. LD is here. Tree Climber, Jules, Tinker, Jeff McCarthy. Thank you, everybody, for joining. We appreciate you being here. Yeah, I see all sorts of problems with the Europeans' mega bank solution. Now, how does that relate to central bank digital currencies? If we look at what we talked about in the US and in China and all those places going to the big CBDCs, the big cryptocurrency, centralized cryptocurrency monetary regimes that each of the central banks wants to do. It's central bank digital currencies. Those central bank digital currencies need a system where they can control large swaths of the population, large aggregate money flows. And remember what I said, when you see the money and the commodity side are integrated, and trade are all integrated, and geopolitical conflict is all integrated, because what it all boils down to is who has control of resources. Money's just a way to control resources, to control the markets, and to control the flow, control the pricing, control who gets it, okay? Market inflow, stock and flow. So those commodity markets control it. So they're having consolidation of commodities markets and trade unions. Look at the BRICS in China, look at the US, and then the commodities markets are controlled as well. And they need to control the money markets as well, because that's what facilitates being able to buy commodities dirt cheap. And the only way to make that efficiently controllable around the world is to build these big blocks. So to build first these big trading blocks. That was like NAFTA first, and then other North American trade agreements and Chinese trade agreements. Those control the flow of goods. After you control the flow of goods, you control money, because money's capitalized for what? To build stuff and to buy stuff and to use stuff. And so here the capital market consolidation is occurring. The commodities market and trade market has been occurring. The de-dollarization has been the multi-polarization of the financial system. And now the European Central Bank is getting into it. And by doing this, they're also basically saying, we're going to be a lot like the Fed, and we'll work with the Fed, but we'll be the size of the Fed, so we'll have our own power. So it's part of it is Europe saying, we want to exercise our own regional power so that the Fed or China, and they're reading the tea leaves on both sides, the Fed can control, or China, Russia could control. So Europe is saying we're the world's second largest economy. Let's get control of our own system. But they're headed down the road everybody's headed down, which is the central bank digital currencies. And they need control of that monetary system and of the banking system to affect central bank digital currencies. It's a requirement. And they need control of the debt system. And they need control of the commodities market so that they ultimately can control the flow of goods, which is what the currency system is for, is to control value, control flow of goods, to control labor. Once you control the economy, you control everything. You control politics, you can control culture, you can control infrastructure, you can control winners and losers in the financial system. And that's essentially what they're doing. Now, it's insane. It's going to fail. Them smushing together their depositors, their commercial deposits and loans with investment capital means that the risk factor in European banks just went way up. And what's more likely to happen is a Lehman type of event where you have people taking in deposits on a long term and investing in short-term riskier assets. And you're going to start seeing Silvergate banks, and you're going to see more Credit Suisses over in Europe. They're going to start to collapse when this happens. It's just going to increase moral hazard. It's going to increase risk-taking. And all the laws on the books are even worse than they were in the US back in the 30s when Glass-Steagall was implemented, because now you have all these bail-in and bail-out laws. And so that's not good for the people. And that's going to lead to the control over the entire banking system. And they need to have the entire European Union in it so that they can issue that digital euro, that central bank digital currency. They can't do it when any of the sovereigns have their own banking power. They can't do it when the private companies are doing money transfer businesses and money facilitation businesses and other types of things. They need all the control, the nexus of control, to reside within that banking system. And so the politicians have got to pass these laws. And that's why you have everybody talking about, and they're going to talk about, corruption. They're going to talk about, lack of liquidity as reasons. But the reason those occur is because of the system in place. So they're using the problems caused by the system in place to advocate for a new system that's going to be even worse for you and me on an everyday basis. And that's not something that we want. And that's going to strengthen the central bank digital currency in Europe. It's going to strengthen the control that the bureaucrats have. And you see this happening in the US, you see it happen in Europe, you see it happening in China and Russia. And we're going to a world in which you're going to have 4 or 5 or 6 or 7 really big, geopolitically heavy or significant population states, banking systems, trade networks, monetary unions. And that's going to be where the new geopolitical system is aligned. And you're going to see conflict between that. Some collaboration, but a lot of conflict. So you're going to have much less local, state, and national sovereignty as individuals. You'll have less opportunity in the economy. You'll have more control over the money and banking. That's all coming to Europe. And I hope that people in Europe are watching this, because we did broadcast it at 1 p.m. So a lot of people in the UK and Europe can be, and in our audience can be watching this. Write, talk about this, get on the news, right? Do whatever you have to do a peaceful protest, but don't allow them to put this system into place, because they do. You're going to lose your national sovereignty. Once they get control of the money flow, they control the politicians, they'll start passing a bunch of laws. They're going to reduce the ability of any nation state in Europe to have its own sovereignty. And you'll have less people at the top running all of it, not just the banks, but the politics. All the money flows, the trade, and everything. And that's not good for the people. That's less good for the people. So I want to make you guys aware of it. Thank you for joining the program. That's going to about ended up 56% of you said it can't be stopped, the super bank empire. I think it can be. And I think we may have a different opinion, but I think you're right in that this is such a strong movement. It's going to take everything everybody has to stop it. And more than likely, they'll get some of these pieces in place, if not all of it. And it probably will collapse at one point. If it's allowed to stay in place for a long time and you get a couple of generations used to the system, we're not going back. So we have to be the ones to fight the system now and to say, this is not the system that the people want. Because if you allow a generation to learn this system, it's much harder to unwind that than it is to stop it at the beginning. So this is why we want to talk about this now. Thank you, everybody, for joining the program. I did have a contribution from Steve at Steve Ross Homes. And a question: when gold takes off, do you think rare coins will appreciate at the same rate? My experience, Steve, is that, well, my own personal experience, I use anecdotal experience. When I did research on the numismatic or collectible gold market, I liked it because there was less fluctuation. Now it can go up and down. It's like any market. It's a collectible market. And so depending upon what people want, it's kind of like an artwork, right? Or an antique car, or something out of the 1600s that has some sort of historical value. There is a lot of value in the eye of the beholder. However, the index, the PCGS index that I look at, and some of these other rare coin indexes tend to be a little bit more stable even than gold itself. And from 2018 to 2022, it was my best investment in terms of return. And I cashed some of that in and took it and put it into a business venture I wanted to do. So for my own personal experience, I do like the numismatic market. It's not for everybody. So I'm going to stick up this banner about we do not offer financial or legal advice. Please do your own due diligence and consult a financial advisor or legal professional before making any investment decisions. For you, those of you listening on the podcast, I'm going to read that out. The reason I put that up there is because I can't tell you what to do. And numismatics, a lot of people look at it and say it's a sham and all that stuff. All I can tell you is it worked for me. Now, there's more knowledge required to be in that market. So I had advised looking at a couple of coins and getting familiar with them and doing your research before you jump in. But I like the market. It's a little bit more speculative. I think it's actually less volatile than silver, to be honest with you, the collectible gold market. So I kind of like gold and then collectible gold and then silver in terms of volatility perspective. I think silver has a much higher end than either gold or numismatics. But when gold does well, numismatics do better. And numismatics can outperform gold during times in which gold is heavily demanded. And that's why I'm invested in. Please do your own due diligence on that. And thank you for the question, Steve. I appreciate that. And the contribution. I think that's probably going to do it for us today, guys. Just a reminder, if you're interested in asset-backed digital currencies, we do support all of them. I think there's LODE, there's Aurus, there's Kinesis, and other ones as well. I wanted to advocate for Kinesis. So if you're interested in Kinesis and storing your gold and silver and having the ability to trade or send money or to use a debit card in many areas or a virtual debit card and spend that gold and silver and also get rewards for holding and spending it in a system that's designed to facilitate gold and silver as actual money again, I strongly recommend Kinesis. And again, do your own due diligence before you sign up for anything. But I've really loved, what they've brought to the table for me. I use it for business, as a matter of fact. We're basically doing a business expansion at the moment. And I essentially am using money from that I store in Kinesis to help with that. And it's very easy because, as you can see, recently on my Twitter, I bought some stuff from Home Depot using that. I've sent payments, to employees with that. It's a cool system, and I happen to like a lot. So if you're interested in Kinesis, go to kinesis.money, look for more information there and sign up if you wish. We do have an affiliate link below. It does help the program if you sign up through us. But I would just say, look at it, see if it's, for you. Some people like to store their gold and silver at home. I think home invasion risk is a real thing. The statistics are going up. So I like to store mine in a safe place, especially since I'm online and people know I have it. I can't store mine at home. So there's certain use cases where storing at home is not a good idea if that's the case for you, or you just want to be able to facilitate payments with it, but not carry it around. Look at kinesis.money. And I think it could be a good alternative for you. That's going to do it for today. Thank you, everybody, ladies and gentlemen, for joining the program. We're going to go ahead and end it up. This has been European Union building a mega bank to control the region's financial system. I told you exactly how they're going to do it. I told you why it's insanity for us, but not for them. And I told you what the potential repercussions could be and how that dovetails into the CBDCs and why they have to have this for the CBDCs. So if you don't want the CBDCs, stop the integration of the commercial and the industrial side or the investment side of the banking system. And that's one thing that will prevent it. Also stop these international bodies that have no sovereign authority in your nation from dictating policy to your nation's leaders. Your nation's leaders are taking dictation from some of these international and financial agencies. And it may be time for you to question them so that they stop. Okay. So that's going to do it for today. Until next time, this is Rob King of Gold Silver Pros. Y'all have a great day.